Good morning. You're watching The Market right here on ET Now with me, Aisha Faridi, Nikunj Dalmia, Avand Bash on the show. And the Wall Street rally clearly continues. We're working with global cues almost on a daily basis. If you just look at the two-day move, the S&P 500 index has managed to put on a good show, about a 3% move. And it's actually tech stocks which are staging a bigger comeback. So the Nasdaq has perked up a good 4.5% in just the last two trading sessions. But looking at the FII flows in the last 12 months, India is down about 16,950 thereabout crore rupees, and month to date alone, we've lost about almost 1,600 crore rupees. So I think that story continues. While India is still outperforming year to date, month to date, we're starkly lower.
Aisha, I looked at the data in the morning and I said, hamara samay kab aayega? Look, it's been a good start for global markets. Nasdaq, S&P, other emerging markets. It's been a good start. Look at S&P two-day move, Nasdaq up 4%, S&P up 3%. In India, the underperformance I think is now visible. The underperformance is very obvious and flows are gravitating not from equities, but flows are gravitating to other emerging markets. Variety of factors are at play. The world fell apart in 2022, we were standing tall. The world is making a comeback, and that in a sense, stocks in other emerging markets are attractive, and that explains that when the fear of interest rate hike is receding, and when central bankers are turning slightly dovish, and the tone is not hawkish, money is gravitating back to markets which have underperformed, or fresh flows into India are just not there. Now that's the picture, just think about it. Nasdaq is up 9% this year, S&P is up 5%, and Nifty is jumping in the same place. And Nasdaq is a representation of Google, Alphabet, Apple, Microsoft. These companies and these companies are laying off. They're cutting costs. Yet these stocks are going higher. So what are markets telling you? That India did well in 2022, but that outperformance, unfortunately, is costing us right now when the world is normalizing.
Yeah, I guess it's always about the relative performance, right? I mean, if you look at the Taiwan market, for instance, which is largely electrical, technology, chip-heavy economy, look at the last 12 months. They've seen FII outflows of 41,533 crore rupees, and we're just equating it into rupees crores just to put it into perspective and try and make that apple-to-apple comparison, if you will. And month to date, they've seen the biggest inflows of 4,500 crore rupees as opposed to India's outflows of 1,600.
Yeah. So, what decides the flow pattern in the short term? Relative valuations and near-term scope of recovery. Indian markets will do well, so economy will chug along. But earnings are not going to be substantially upgraded for FY24. But for other markets, valuations are attractive and the world comes back. The earnings upgrade cycle, or the surprise for, let's say, other emerging markets is going to be greater and higher. That, I think, becomes this entire motivational factor for global money allocators not to look at India, which is expensive, and earnings surprise will not be there. In second half of this year, we'll start talking about the election, the political stage. So that, in a sense, is the reason why flows are not coming back into markets like India. It's unfortunate. I was hoping that we will get flows in terms of an allocation, but if this kind of a trend continues, we could be in a bit of a spot of a bother. Then you've got the local crowd. The local crowd is saying, let's wait till budget. If there is tinkering in the taxation, then you might as well come out. Once markets, might as well wait for the budget to be tabled and then take a view, because if you buy at these levels, stocks are not cheap and the margin of safety is not there. Bottom line here is that you are jumping in the same place. We are not participating in the global market. FIs are selling and they're going to other markets, and the local crowd is saying, we'll wait for the budget and we will come back, which means next 4-5 days, nothing big is expected.
But do you think that the budget would be that key turn of events, given the fact that as of now maybe valuations are not compelling? So would the budget change?
One is that what we spoke about right now is the headline index, Nifty, Sensex. But it's not that everything in the market is expensive and everything in the market is cheap. Look at banks, they are growing. Look at autos, they are making a comeback. Look at IT, selectively they are making a comeback. I think what budget will do, if there is no tax tinkering, it's going to be a mighty relief. You may see a bout of short covering rally, and what you may see is that budget, if there is nothing negative, if it's a no harm budget, then rather than the Nifty, it will pave way for individual stock outperformance. What we've seen in this earnings season, Aisha and Avan, is that whatever may be the company, whatever may be the outperformance, whatever may be the nature of the commentary, if it is good or if it is bad, markets are punishing it. If it is good, markets are getting ignored. Post budget, I think that will start getting recognized.
Okay, that's the big event, 8 days away. And of course, we've got a stellar lineup and a plethora of guests to decode the big event for you. But back home, let's focus in on how we wrapped up the trading session. It was at 18,100, above those levels. We were up about 90 points for the Sensex as well, around the 60,900 mark. And that's the trade setup. We were above the 50 DMA. There was short covering being witnessed. The broader markets didn't quite play catch up. When I say broader, I mean in specific the mid-cap end of the market. Overnight, in terms of cues, as Aisha said, it was pretty healthy from Wall Street. In Asia, most of the markets have traded higher, but it's the Lunar New Year holidays that's been seen in most of the region, and that's the SGX Nifty indicating a 0.5% up move. But apart from looking at the overall data, it's interesting to see that it's a lackluster expiry as well that's in store. The average rollovers are lower, as the Nifty has seen about 34% and Nifty Bank about 45%. But what we'll also be focusing on with a magnifying glass, and what we have been speaking about, is the kind of earnings that have come out within the banking sphere. Now, over the last 11 quarters, interesting data that we've compiled from some of the top banks, which ones of them have managed to beat street estimates and which have missed. So HDFC Bank, for instance, has beat estimates about 4 times in the last 11 quarters. That's the data stacking up. ICICI Bank, Kotak, as well as IndusInd stand at par, and you've got Axis Bank about 8 times. So Axis, Nikunj and ICICI Bank have managed to beat about 8 times in the last 11 quarters.
Yeah, so if you frankly ask me that there are two things which are happening in the market. One is that where banks in a sense are giving you growth in terms of credit and also in terms of maintaining their margins, and where the earnings surprise is the highest. So the top draw there, I think, is Axis Bank. Cheap, has not participated, was the late to jump on the banking rally, so to speak. Numbers have been strong. Now markets are convinced that the worst of the book is behind them. Axis for the longest time has struggled for inconsistent delivery and for a poor book quality. I think that wave is behind us. And Axis, in a sense, is at a new cusp of a new avatar because of the acquisition of the credit card business, also what they will do in order to move out in terms of forging the entire insurance business. So Axis for next couple of years now becomes a completely different franchise, so to speak. Second, I would say HDFC Bank, even though it's been consistent in terms, it's not beaten a lot of estimates, but the CASA, I think, is strong and the deposit growth is strong. So there are two factors which now would be at play. See, SBI is rediscovered. SBI, everybody knows, is headed in the right direction. ICICI Bank, the re-rating is done. Within Kotak and HDFC Bank, I would say it's a difficult one, but I would say HDFC Bank because again it has underperformed and CASA is strong. But Axis is the one where I would say that the real bank for the buck or the re-rating is still left, given that directionally where the franchise actually is headed.
Okay, so we have all the private sector lenders' earnings in, and that's what it's looking like. The editor's stake as well. Maybe you'll see the maximum re-rating in Axis Bank. Now, you just heard Nikunj in the editor's stake talking about how the local crowd is waiting for the budget rally. And in the run-up to that and the big event on 1st of February, we've been asking our market guests about pockets of opportunities. In the last 2 years, you've seen a phenomenal run in SBI. You've also, of course, seen how defense stocks and other PSU stocks have picked up momentum, PSU banks as well. Can that momentum carry on? Here's Saurabh Mukherjee of Marcellus with his take.
Whether overseas investors buy or don't buy PSUs, it's not part of, in a way, it's not our concern. Whereas I've said historically, our concern on PSU has been the PSU serving two masters. It's serving its owner, Government of India, quite rightly. The government owns the PSUs to propagate a bunch of goals around national development. So, for example, the government owns Power Grid or NTPC or Coal India to make sure that you and I get affordable electricity, and the same is rolled out across the length and breadth of the country, right? And therefore the PSU's primary responsibility is to serve its master, the Government of India. A secondary responsibility is to serve shareholders. And that's why our belief is it's difficult for a PSU to generate results for our clients over long periods of time. They will have these bursts of activity in the share price when, say, Coal India goes up 60-70%. That's fine. But to the extent you and I, none of us who on the show know who's going to be running Coal India or Power Grid or indeed State Bank of India or Bank of Baroda. We don't know who will run that PSU 5 years hence. And therefore, we don't quite know who exactly are we backing. What we do know for sure is the master of these companies, the owner will be primarily Government of India, and these companies therefore have to serve the national imperative, not the minority shareholders' interests, and hence the avoidance of PSUs in Marcellus.
Powered by 1 billion consumers, India has now emerged to be the world's fastest growing large economy. In this budget, will the Finance Minister announce measures and policy initiatives that will boost consumption in India? Join me, Nilesh Shah, as I analyze the budget on ET Now.
There you go. We will, of course, get you the best of experts right here on 1st of February before the Finance Minister gets up for the speech, as well as after that, analyzing it all for you. Well, that time of the show where we also recap all the top global events that you need to watch out for, and as well as the important commentary that's come in overnight. Every morning, Anisha compiles that list, and as always, here she is live with us. Good morning, Anisha.
Hi, good morning. Well, let me start with the comment coming in from Mohammed Al Irian, wherein he believes that inflation levels are still not encouraging. He believes that it's likely to remain sticky because inflation has now moved away from goods into services as well, and that's much harder to contain. So far now, not encouraged by the inflation, slowdown that we have seen over the last many months. This is something which is echoed by Christine Lagarde of ECB as well. She says that it looks like the ECB will have to hike rates at a faster pace going forward and stay in the restrictive and tightening phase for much longer than expected because inflation still continues to be sticky, and she believes that they'll stay high, the interest rate will remain at those levels for as long as necessary. So there's not that cut that the street is talking about. Lawrence Summers is a bit more optimistic because he believes that the Federal Reserve is dealing with a very difficult job at the moment in order to, walk the tightrope between inflation as well as growth. He says that while there is continued strength in a lot of the macro indicators, there is signs that tell you that inflation is coming off, and that is something that gives him a tad bit of more confidence with respect to how the Federal Reserve is dealing with this crisis. Shifting focus and talking about what the commentary is coming in from the corporate world, let's focus on what Google's Sundar Pichai has to say with respect to the layoffs that they have announced to the tune of around 6% of the workforce. He says, if you don't act clearly and decisively and early, we can compound the problem and make it much worse. These are the decisions that I needed to make. So that layoff of around 10 to 12,000 people as far as Google is concerned, this is what Mr. Pichai had to say. Separately, just talking about Morgan Stanley strategist Michael Wilson as well, he expects that the market will be fairly range-bound in 2023, but in 2024 is when we'll see that massive rally and rebound, and that's what they're betting on because in 2023, they are expecting that there will be a recession in the US.
Okay, thanks very much for giving us those details. Yes, indeed, Sundar Pichai saying that the steps that he has taken as of now have curtailed many bigger problems that would have arisen. All right, let's put the spotlight then on the markets. We've got Naresh Mirani joining in on the technicals. And Naresh, yesterday we managed to hold our head above the 18,100 mark. You did see quite a bit of support coming in from some of those auto and IT majors. Do you think that the run-up is going to continue? And what exactly is the data indicating when it comes to the expiry, given that as of now, the rollovers on average are slightly lower? Is that indicating that it's going to be a very lackluster expiry?
So starting off with the momentum, the problem is if you look at all the risk parameters across the world, whether it is the dollar index, it is sub $102, and various other global markets continue to be at a good momentum. Say Europe is higher than what it was in June 21. You have United Kingdom at an all-time high. US markets have been stable. Our markets have not taken a catch-up, given that we have an event left, which is the budget. And that is one of the reasons we are yet not able to cross that 18,250 mark. And that is the case also with the derivative data as well as the cash volumes. So it has been one of the lowest volume week in terms of cash volumes. In a lot of stocks, the volumes have dried up quite a bit. And the only places we are seeing a lot of price action is where results have been coming in. So for now, we see further trend going beyond 18,250 post the budget, or momentum in the broader markets to get better post the budget. So yesterday the Nifty was up, but the small cap index was as flat as it could be. So we are still stuck in this band, and I expect this band to be broken only after the budget. So for now, it is a stock specific move wherein more of it would be result reaction or some sectoral rotation.
Exactly what we were discussing on top of the show, right? How you seeing FII sell, move to other markets, and what Nikunj calls a local crowd here waiting for the big event on 1st of February, and that's why the needle is just not moving. So that's the call on the index and the Bank Nifty, Naresh. But what about your stock-specific money-making ideas?
So the next rotation which is being played out is the public sector enterprises. The Nifty PSC is coming at an all-time high. The whole index looks interesting, and that is where the two stocks come in for. First is a buy on ONGC. The stock is given a breakout above the 150 mark. Clearly, after a long time, the stock has started trending up. So that gives us a possibility of a target of 170 to 190 in the short to medium term. A stop loss at 147, which makes it a good risk reward trade. Second is a buy on NTPC. Now, the stock is the largest weight in the Nifty PSC index. The stock has consolidated for a long time now after the initial run-up, and it has been in a long-term uptrend now for the last year or so. In the near term, it has made a strong base around 160 to 165 levels. The breakout point for the stock is 171, preempting that eventual breakout which could happen over the next few sessions. Expecting it to go to a new all-time high. A stop loss at 163 and a target price of 190. Again, a good risk-reward trade.
Hi, my name is Shashank Shrivastava. I'm from Maruti Suzuki, and I'll be taking a close look at the forthcoming union budget from the auto industry perspective. Auto industry, as you know, has had 3 really tough years, and in fact the last year was actually good from a volume perspective, but the challenges continue. So I'll be talking about the expectations from the industry regarding how to make growth a reality for this industry. So tune in to ET Now as I decode the union budget from an auto industry perspective.
All right, lots lined up for the big B, but in the meantime, let's hear it out then from Charandeep Singh. He's founder and managing director of Girik Capital. He believes that it's going to be a very similar budget to what we saw last year. Let's hear out his expectations.
And tinkering with the taxes, it's very important once you set up a tax regime, which is not more than 4 years old, to let it run its course, I don't think that it would be taken very well by the market at all, any tinkering, which is adverse, be it increasing the long-term tenor or making long-term and short-term at par. It's very important to have consistency in tax regime. And I also hope that this stays its course, the current tax regime, because you've already tinkered with it once in the last 4 or 5 years. So I think that, yes, I would be in the camp and favor. And, one might think it's self-serving, but that's not the case. I would just say be consistent. And consistency is ultimately, you're a long-term winner. You show the world that you have a stable tax regime. It increases the confidence of investors manifold. It'll be a similar budget to last year's, wherein the government has emphasized spending on infrastructure. I think that spend on infrastructure will continue because that train has left the station. So I think emphasis on infrastructure development and manufacturing. I think these are the things that should continue to get benefit in the coming years, especially now.
Our second technical expert, Manoj Muralidharan from Religare Broking, now also here with us. Good morning, Manoj. So as we head towards opening bell, what's your call today when we talk about the indices, the Bank Nifty?
Good morning. When we started this series, FIS had a long position somewhere close to 55-56%. And then eventually it mellowed down to almost 30-38%. But if you see the last 4 to 5 trading sessions, there has been good amount of long built up and a combination of short covering as well. So they're back to 56. So it's an entire cycle which is almost over, and we believe that obviously the next weekly expiry, the first weekly expiry that we have in Feb is on 2nd. So obviously that is post the event, and we are seeing good buying and long rollovers happening both into the Nifty and Bank Nifty. So ideally a trade today would be, let's say 42,800 happens to be a good level to go long on Bank Nifty, a 200 point stop on the downside, and a 43,200 can be the intraday target for the Bank Nifty. For the Nifty, we believe 18,250 might be a good target, and buying Nifty futures somewhere close to an 18,160 to 170. A stop loss of 18,130 also can be a good strategy which can be done.
All right, let's get in those top recommendations going. And what are your bets?
Well, stock specific and sector specific, because this is expiry, we see a lot of traction which is happening, and there is a beautiful ratio which goes on between the Bank Nifty and Nifty. It is currently at 2.36. So you simply divide Bank Nifty by Nifty, the ratio is 2.36. So we believe the resistance for this is somewhere close to a 2.38. Kotak Bank tops the list. We believe there is good buying in Kotak Bank. So 1788 is a good level to go along with the stop loss of 1760. The target would be 1830 on that. And from the oil and gas, we believe ONGC, if you see, I guess I mentioned it last time as well. In the October series, the base of delivery buying, I believe from the institution side was more from 134 to 138 levels. Even yesterday, a good build-up of almost 20% in terms of long rolls as seen into the Feb series. So we believe 158 is a target we might have on this, and at 151 it can be bought. The stop loss should be somewhere around 148 in that.
Okay, so those are the Cracker Stock ideas coming in from our second technical guest that we have on the show today for you. Well, back to earnings, and we were just talking about, is Axis Bank all set for a big re-rating after a solid set of numbers that have come in? We've started to see the momentum building for HDFC, with the elephant can dance. What about Axis, and what are brokerage firms saying? Let's go across to Harsh to find out more. Good morning, Harsh. So good set of numbers. Brokerage reports are in. Is this a stock that's in for a big re-rating?
Well, yes. Let me first take you through the numbers itself. The net interest income went up a solid 32.5% on a year-on-year basis, slightly elevated or slightly higher than what we had really penciled in. Operating profit also therefore was slightly higher than what we had expected, but so were the provisions. We were expecting sub 1,000 crore worth of provisions, but Axis has this time provisioned for almost 1,400 plus crore worth of provisions, and therefore PAT slightly above what we had penciled in, 62% growth in PAT. Now, in terms of the highlights, the NIM number was extremely good, 4.26%, but also contained a 5 basis point worth of one-off. So around 4.2%, a very healthy NIM number there. When I'm looking at slippages as well, what they have suggested, or the commentary has suggested, is that there are non-recurring prudent items which they've provided for this time around. So therefore, slippages are a little elevated. Overall, OPEX continues to moderate, so that's a positive. Advances growth at 15%. Largely, it's still below system level, so that's something that Axis needs to figure out. And 10% deposit growth as well. That also largely in line with the system, but obviously slightly slower than some of its larger peers. Largely with regard to brokerages, well, we'll start off with Morgan Stanley. They continue to maintain an overweight. They've upped their price target to 1,200 rupees a share. They've increased their PAT by 9%, or rather, PAT has come in 9% higher than what they were estimating, and they've increased their PAT going forward, their forward projections for PAT as well. Valuations, they believe, at 1.8 times FY24 forward looks very attractive, and asset quality is better than what it was at normalized levels. JP Morgan also has an overweight on Axis Bank. 1,100 rupees a share is their target price. They believe that NIMs were largely aided by rate hikes, which is the reality. Loan growth is up 15%. They believe that's reasonable but lower relative to peers, and they've increased their FY24-25 EPS estimates by around 8% on the back of those higher NIMs. They believe that Axis Bank can sustain this higher ROA profile. And let's quickly go on to Axis Bank's management, listening to what they had to say yesterday.
We are seeing a broad-based growth in corporate loan demand. There is strong activity in segments like renewables, roads, chemicals, urban energy distribution, commercial real estate, and healthcare. Capacity expansion projects are picking up, especially in consumption-driven sectors. Pricing has seen improvement compared to what we were seeing 2 to 3 quarters back. We continue to choose opportunities that meet our return threshold. Third was around fostering a winning mindset. Like I mentioned earlier, Axis mobile app is the world's highest rated mobile banking app on the Play Store with a rating of 4.8. It has over 16 lakh reviews, which is the highest across 59 global banks, 8 global neobanks, and 50 Indian fintech apps. The app now handles over 65% of all service requests by volumes. We also retain our leadership position in rupee-denominated corporate bond issuances for the 16th consecutive year based on Bloomberg League Table for India bonds.
All right, let's move away from that and put the spotlight on M&M. CLSA has got a buy rating on the stock. They've upped the target price, saying that momentum across business segments looks strong and that their SUV business as well is looking healthy and is on a roll. Ashesha is here to give us more details on that CLSA brokerage note. Morning, Ashesha.
Hi. So yes, CLSA has come out with a note on M&M. They're maintaining their buy rating on the stock, but they've increased the target price to 1,592 rupees per share. The stock currently trades at about 1,330 odd levels, indicating a 15% upside from the current market price. They also say that momentum across business segments for M&M continues to remain very strong. SUV business, meanwhile, is on a roll, and tractor business was on a solid footing in FY23. They believe El Nino effect needs to be seen as a big trigger for the stock. However, they've gone ahead and increased volume estimates for M&M by 3 to 8% over the period FY23 to 25. And hence, for now, CLSA is maintaining their buy rating on the stock with a target price of 1,396 rupees per share.
Right, we'll leave it at that, Ashesha. And auto major Maruti is all set to declare its Q3 numbers today. The company's margins are expected to surpass 9.5% after 2 years, and volumes as well are expected to increase on a year-on-year basis. For more details, let me take it across to Srishti.
Well, for Maruti Suzuki this time around, firstly, let's have a look at how the volumes played up in Q3 FY23. So the volumes were down on a sequential basis. They were down around 10%, but a good jump on a YY basis. And that's exactly what we are expecting onto the number front, because all the headline numbers will show a growth on a YY basis, but a decline on sequential basis is what we are expecting. Firstly, onto the top line, not just the volumes were down, there were chip shortages, but on the flip side, a richer product mix is something that will aid the numbers. in all, we are expecting a decline of 9.5% on the revenue front at 27,162 crores is our estimate. The EBITDA is expected to decline by 4.5% at 2,647 crores is our expectation. And let's talk about the margin front. We are expecting a number of 9.7%, and if the company reports margin above 9.5%, that number you will see exactly after 2 years. A 40 bips expansion on a sequential basis is what we are expecting, purely on the back of the cool off in the RM cost inflation, and on the flip side, a lagged impact of the yen depreciation against INR. And lastly, let's talk about the profit figure. A drop of 9.5% on YOY basis is what we are expecting at 1,873 crores is our expectation. But barring the numbers, we'll also look out for the management commentary on the outlook on the sales figure, the latest sales number from Jimny and Fronx, because we are getting to know that 1,000 per day booking is what the company is getting for Jimny. So we'll have more clarity on that, and also onto the demand outlook is what we will be looking out from the management front.
Our expectations from the budget are based on three key themes. The first one being a budget that stimulates growth, as has been in the previous budgets of the last few years. The second is supporting the infrastructure growth, because infrastructure growth is key to the development of travel and hospitality business in India. And finally, a tourism booster. It is time that this sector gets a booster dose, so that the sector that suffered the most, demonstrated the highest level of resilience, is not only coming back on its feet, rather is contributing the maximum in terms of new job creation as well as indirect job creation.
Okay, there you go. You'll see the top boss of Taj Hotels, the one who rewrote the comeback story also of Indian hotels, will be with us on Budget Day as part of our think tank all day on 1st of February. Right, here's more fundamental ideas that are coming in for you. Time now for Sanjeev Bhasin. And this is why he is still betting big on Bajaj Finance as well as the Bajaj Finserv. Here's Sanjeev Bhasin on the Bajaj Twins.
My topic would be Bajaj Finance. Bajaj Finance has seen an inordinate fall just because of one quarter numbers being slightly below. But the people are missing the woods for the trees. Look at the amount of gross additions of new accounts. It is a record. The numbers on 27th will be a record profit for Bajaj Finance. I think this is the best time to buy this blue chip. At 5,950 to 6,000, buy Bajaj Finance. 6,500 is coming before the budget. Stop loss of 5,750. My second pick is Bajaj Finserv. That's the holding company of Bajaj Finance. It owns 100% in the AMC. It owns 71% in Bajaj Life Insurance and in the AIF. It is the best play as far as the NBFC goes. And the next thing could be that by the budget, they are expecting a banking license. This stock is available at the best valuation in the last 3 months. At 1350, put your money into this stock. Look, keep a stop loss of 1315. Look for targets of 1500 coming in the next fortnight.
All right, let's get stock specific then with our chartists. And Manoj, what do you make of the kind of grinding low that we saw in those cement stocks attributed to fundamental reasons, but not just Ultratech? The entire basket was under pressure. More pressure on the cards?
Yeah, I feel there is a possibility because, as you said yesterday, yes, there was good amount of shorting, but then we would like to play this more from a budget point of view, and we are looking into those sector and stocks which would be more rolling into the Feb series. So I guess even like we were discussing the automobile sector, I guess I would still refrain from cement. I would still stick to something like a Tata Motors, somewhere close to 408. It still becomes a better bet to go long. At least with a target of around 424 with a stop loss of close to 400 to 402 on that.
Right, just looking at some of the other movers from yesterday, and definitely it was a mixed bag. But yes, one could see mid-cap IT make a comeback. So be it an Intellect Design or for that matter, Persistent or a Coforge, all these stocks sprung up anywhere between about nearly 5% to almost a 6% dash coming in on Coforge. Naresh, is that a trend in the making here? Have IT stocks bottomed out?
Yeah, so that is what it looks like clearly in terms of the trend. And what has happened is we earlier saw the TCSs, the Infosys make a bounce back, and now we are seeing a bounce back in the mid cap and the small cap names. And then it should percolate across the smaller cap names also. So Coforge, we discussed it yesterday also that it has given a breakout in the near term, and the momentum is pretty strong. The ones which still look interesting because now this is a sector which one has to be careful given that we've seen a very sharp correction and this is still not a strong uptrend. This is just a recovery after a 40-50% fall in the mid cap, small cap IT space. So that is where we'll go with the names which have already corrected and just starting off. So in that case, LTI Mindtree looks interesting. That could go towards 46, 4700. One would keep a stop loss at 4300. Second is a Birla Soft, which has corrected almost 50% from the top. That can make a comeback. Then in the large cap space, Tech Mahindra is something which is setting up for a move towards 1150 to 1200. So I expect a 8 to 10% bounce in the small cap and mid cap IT names, which have fallen a good 40-50% from the top. Not expecting a 25-30% move up. So it's a trade for the next few sessions wherein you could get a 8 to 10% bounce back. Keep a stop loss at 2.5%.
Okay, so that's as far as the mid-tier IT stocks go. The question we are asking about whether they can stage a comeback or not. Well, right on top of the show, if you tuned in, you would have got the editor's take when they couldn't talking about how FIs are selling and moving to other countries, and the local crowd is waiting for the budget day for the needle to really, really move. In the run-up to that, we're of course reaching out to a whole host of experts for all of you. And here is the Managing Director and CEO at Max Life with his expectations from the Central Exchequer on Feb 1st.
I don't just look at one event. I think there's a lot happening in the ecosystem from a regulatory perspective, from the law perspective, insurance law, as well as budget. And you would have seen a very dynamic and positive environment which is being created, which is giving me a lot of hope and optimism, not just for FY24, but next 5 to 10 years. And you would have tracked all of them. With respect to this particular budget, I think budget focuses a lot on taxation and elements of those kinds, especially around corporate taxation. So my recommendation will be to create a carve out, especially for life insurance, and within that also for protection, because you would have read as per 2020 Swiss Re report, the protection gap in India is 90%, which is one of the highest. And hence treating protection as a separate element is very important, and a fiscal incentive always goes a long way to propagate that. So there is definitely an ask, but at the same time, you know, the ATC benefits, yes, they are available to everybody, yes, a wide range of instruments, and it has not been inflation adjusted for a very long time. So there will definitely be an expectation that there is a carve out that we're doing. The third element will of course be around retirement. For a long time we have been representing that annuities have to be treated a bit differently. The principal also get taxed, which comes in the way of driving annuities in India. So that's the third one. So really with these changes, I believe that protection and retirement, which are big needs for India, will get a big impetus. So that will be my
yes, sir. The government is also coming up with an amendment in Insurance Act, and there is a proposal of composite license. Just now, DFS Joint Secretary Saurabh Mishra spoke about that life insurance.
Okay, that was the budget wish list from Max Financials. Chakri Lokpriya, good morning. Are you ready?
Yes, sir.
How are you, sir? Running late today? What took you long?
There's some audio video check questions.
Okay, now that I can see you, you can hear me, audio video check is done. Can I ask you a question?
Please, sir.
When will markets go higher, sir?
Yeah, you know, this budget basically is the last budget. So clearly, you know, the good news is both at the central level and the state level, the fiscal deficits are in control. So this allows the states as well as the centers to do a lot of capex infrastructure spending. And that will not only kickstart the growth of the economy, the underlying bit of it, it creates jobs important for in the run-up to the elections. So from that perspective, PSU banks, because they are the ones who fund infrastructure, cement, all these cyclical sectors, near-term cyclicals, are the ones which are likely to do well. And therefore,
these are the sectors which have kind of underperformed, and they can hold and take the market up probably a good 10% for the rest of this year.
Wondering whether IT has bottomed out or not, and is there any merit in correlating to what the Nasdaq's performance has been? We were just looking at it. Year to date, it's already up almost about 5% or so.
Indeed, and IT has the sector has bottomed out in terms of its valuation. So all the fears about the slowdown in the US impacting order books, it's kind of reflected if you look at the multiples. The earnings, basically this ongoing quarter, there's an expectation that the order book will be even more muted. So that's how, and based on that, the earnings growth rate is about 13-14% for the large cap and about 18-20% for the mid cap. The multiples are close to their growth rate, so about anywhere between 16 to 20 times. So the downside is not there, and any hint that an inflation is slowing down, the economy is reviving in the US will take these stocks up. So I think this is the time to actually buy the stocks.
Okay, this could be the time to look at a bunch of those mid-tier IT companies as well. Chakri, of the morning of the show, we were of course talking about whether it is Axis Bank that is going to see the biggest re-rating, especially after the numbers that have come out. We've got the numbers from the private sector lenders. Would you agree?
Both Axis Bank and ICICI both have good numbers. It is a trend which is evident across the banking sector, which is NPAs are down, loan growth is improving, deposit growth is improving, and all the provisions are very strong, so that there is a protection against any bad loans. So now what is needed is economic growth, which will kickstart the credit growth, and that indications has been, and it trades at about 1.7 times book. So it is not an expensive bank, Axis Bank, and therefore I think it's for instance, ICICI trades at close to slightly over 2 times, depending on how you look at it. And so I think there is significant valuation comfort in Axis Bank, and there's a good 25-30% upside from current levels.
All right, let's find out which are the other stocks then that you should watch out for in today's trading session. It's time for stocks on the editor's radar. Let's begin then with Gland Pharma. That's in the news in today's trading session, largely on the back of the fact that Q3 has missed street estimates third time in a row. In fact, you have the revenue growth this time, which has slowed about 10% on a year-on-year basis. And that's largely, Nikunj, on account of the fact that the US sales as well have slowed on a quarterly basis.
They represent the injectable business. To just break it for our viewers, injectable business essentially medicines which are injected. The minute you're talking about an injectable medicine, it's a complex business to be in. It's a complex business. It's a complex business which is a high margin business. But guess what? This complex business, which is a very niche business, is slowing down. Now 16% drop sequentially. They're making a case that, look, there was a syringe shortage. But then why for the third quarter this kind of performance is there? Some of those pharma stocks, Avan, post-COVID, they had got massively re-rated. And now that realization is kicking in that the market is tough, the market conditions are tough, and the US generic pricing in a sense will continue to get eroded as healthcare costs, they continue to come down. So there is a big change in the way how you were looking at pharma as a cluster, especially US generic companies. And that in a sense has derated some of the stocks. And in this kind of a market, when you don't deliver, the market reaction. Q3 miss, the market reaction immediately is going to be down. Q3 miss or quarterly number miss for the third time in a row for an expensive stock, that's unfortunate. But the stock is now going to be really on the receiving end in terms of the short-term market direction.
All right, and the results clearly are going to be the key cause of that. Moving right on then, L&T, let's pull up that stock. It's been an interesting 1 month as well. The stock has seen a pretty smart rally. Now, Citi has got a buy rating with a target price at 26.30. They're saying that there's the capex cycle, the boom. There's also the fact that the company is likely to see an up move in their order inflows, and even the ENC margins are providing comfort and are likely to be healthy in the third quarter. This has been quite a standout, Nikunj.
Avan, the minute you say industrials and cyclicals, the first name which comes to on the top of your mind is L&T. But frankly, if you look at the stock performance, and I'm just going to establish this with the stock performance here, look at L&T. That's yesterday's change. But, Patricia, producers, you will find 3 graphics here. The 52-week change, and look at the change in the L&T stock in last 5 years. you'll be surprised that at a time when most of the industrials and cyclicals and other stocks which represent the capex theme, they've got massively re-rated. L&T has done nothing great, 16% in last 1 year.
It's a sleeping giant within the engineering space.
It is a sleeping giant. It's a late bloomer, Avan. But remember, L&T has two big businesses. What L&T, let's say, was in 2018, it's given a 60% move. But to put things in context there, they've incubated big IT businesses in that. I look at L&T as a combination of core business and the IT business. The IT business is about 35%, the core business about 65%. That 35% business is growing at a rate which is higher than the industry average, but the core business now has potential to grow. Defense stocks have got re-rated, railway stocks have got re-rated, industrial stocks have got re-rated. Why poor L&T is not getting re-rated? So I think now there seems to be a acknowledgement that, oh my God, how did we miss this obvious name? That's what Citi is saying. So it's in a fine shape right now. And with IT also stabilizing, I think this really could be the stock to watch out for this year.
Yeah, and if the momentum in the last 1 month is anything to go by, maybe it is a late bloomer that will see its time in the sun. Okay, let's move right on then, and Aisha, find out what else it is that we're chatting about in terms of stocks.
Yeah, before we move forward and discuss more of the stocks in news this morning, here's Gaurang Shah telling us why he likes NCC as a fundamental idea.
At state level and at center level, all the governments are trying to speed up infrastructure related, construction activities, optimize on those opportunities. So our sense is that with the kind of order book that NCC has, the execution that they have shown and expecting that execution to pick up going forward from here on, thereby translating that into revenues and profitabilities on the balance sheet. So NCC, we believe, will have tremendous performance on fallback of execution of order book, and the run rate in terms of realizations on the balance sheet will also improve. Not to forget, I think our sense is that not only in the state of Andhra Pradesh and Telangana, but elsewhere also, they are likely to get many more orders and thereby translating them into earnings pretty soon. So NCC, as of now, we are working with a target price of 110. This is with whatever you've seen up till now in terms of order book and earnings. In case if that improves, then by default, the targets get revised upward. So start nibbling into it. Don't put all your money at one time.
Powered by 1 billion consumers, India has now emerged to be the world's fastest growing large economy. In this budget, will the finance minister announce measures and policy initiatives that will boost consumption in India? Join me, Nilesh Shah, as I analyze the budget on ET Now.
The best of experts will be with ET Now come 1st of February. Before that, of course, we have a long weekend, well, a truncated trading week anyway, with Thursday being a Republic holiday. Aisha, just stepping aside from the stock markets, I bet you've got your tickets for Pathaan.
No, I haven't, Nayantara. I refuse to pay whatever the exorbitant prices are for the movie.
Plus, I believe, for the tickets.
2,100 is what I heard somewhere. Sorry?
Which ticket is this?
Multiplex tickets. Shah Rukh Khan and
I
Deepika
shall wait
Padukone
to
star.
let it come on OTT and then I shall watch it.
Yeah. What about you, Nayantara?
No, I've not booked either. I'm also saving my money. But Chakri Lokpriya, what about PVR? Because, if you've got that as the big multiplex chain, Bollywood after Bollywood movies not doing as well. But if you look at the last 1 year, the stock is given, what, a 7% like return?
Indeed. If you look at the sector as the media sector, the movie sector, it's kind of done very well last year, overall, all India. And that's what PVR is all about. Whether it's Bollywood or South movies, don't matter that much in the mix after some of the acquisitions that they've done. So the industry itself has raised about, I think, some 10,000 crores in the last 1 year. So the prices of the tickets are yet to move up. Yes, you'll have the individual movie releases where you see a short-term spike up, but still the prices are below average. And so they're stepping up on their food and beverage services within the multiplexes to add to the overall prices. So at that time, with a fairly big slate coming up and, having a significant market share, more importantly, and expanding into tier 3, I think PVR is a good stock to hold.
Chakri, but why?
Clear. I understand, the people are moving to OTT, watching movies, but still, as an entertainment for a day out for many families, it still remains a very important source of entertainment and an outing and a social gathering. So, and if you look at outside of the big cities, the smaller cities still don't have an experience, which is what PVR is now creating. If you look at what they're coming up with the thing. So from that perspective, still going out is an important source of consumer spend, translating into revenue for these guys.
I'm going to shift gears and Nuresh, coming back to you. PSU stocks or PSU banks, off late they become slightly rusty. BOB, Union Bank, even State Bank of India. What's going on there? Nuresh, do you think they are likely to slip into some kind of a range with a downward bias?
So I think we already had a very, strong move across the PSU banks, especially the smaller ones. So if you look at it in terms of a Bank of Baroda or a Canara Bank, they've already moved up 100% over the last couple of years. So if you were to look at it, a little bit of a pause is normal. They've just gone sideways. So Bank of Baroda just in June of this year was around $90 and today it is at 180. And for the last 2 months, it has gone sideways. And it has still not corrected a lot from the top, unlike which happened in the smaller names. So the highest point is 195 and we are at 180. So not even a full 10% correction from the top as of now. It did correct up to 170. So the view is the trend still remains strong. It's just a pause as such. Same is the case with State Bank of India. That is the place where I'm more bullish because in relative terms, over the last 2 years or 1 year, it has underperformed the whole PSU banking space. The stock had topped in November 21 around 530, 550. And today it is still at 600. So over the last one and a half year period, the stock has not given a huge return as such. And eventually I expect this to break out. So going forward, I would expect SBI to be the best bet in the PSU bank, even if you consider the smaller ones. And in terms of PSUs, I think the whole PSU basket X of banks has now started looking interesting. The Nifty CPSE index, the Nifty PSE index is now coming at an all-time high. Although on a dividend adjusted basis, they gave a breakout quite some time back, but we are getting into the next leg of momentum across the board. So I think the next big sectoral rotation is on the PSE rather than the PSU.
Right. Okay, let's move on and let's shift focus to some more mid-cap earnings. Poonawalla FinCorp, the Q3 numbers came out and what a stellar set of numbers this has been. Clearly a dhamaka set. Let me take it across to Ashesha and find out what the details are.
Absolutely. Very, very good set of numbers coming in for Poonawalla FinCorp this time around. Profit after tax has seen an uptick of nearly 88% on a year-on-year basis and 16% on a quarter-on-quarter basis. And this is due to margin expansion that the company enjoyed in the quarter gone by. Remember, Poonawalla FinCorp continues to pass on rate hikes to its customers, which led to margin expansion in the quarter gone by. Net interest income, meanwhile, saw growth of about 10% on a quarter-on-quarter basis and 24% on a year-on-year basis due to net interest margin expansion of nearly 39 basis points on a sequential basis. In fact, the company also posted highest ever disbursements of 3,400 crores, uptick of 9% on a QOQ basis and 157% on a year-on-year basis on account of organic expansion. Apart from this, management guidance is also pretty strong. They say they are targeting AUM growth of 35 to 40% over the next 3-year period. Constant return on asset ratio of nearly 4 to 4.5%, gross NPAs in the range of 1.3 to 1.8%, net NPAs in the range of 0.5 to 0.9%, and profit growth of 30 to 35%. So good set of numbers coupled with strong management commentary and optimistic guidance going forward. Good set of numbers coming in from Poonawalla FinCorp.
Going to be a stock to watch on our radar. Chakri, wanted to get in your take on what the outlook is for L&T. Just a short while ago, we were discussing this counter. Yes, there's a favorable capex cycle. When you talk of this space, the name that definitely comes to mind is always L&T. Do you believe that we are likely to see that re-rating and that catch-up play?
Nikunj was absolutely right in his observation about the sum of parts valuation for L&T. And, given that a good nearly 40% of its valuation comes from in the information technology, its holdings in these IT companies, and which have not done well for the last year. Last year, IT as a sector was down as 25-30%. And all those fears kind of, held back L&T's valuation, IT exposure valuation. Second, CapEx itself was not strong because of the rising interest rates. But now, with so many state elections leading into a national election, and the state financial fiscal budgets being strong, so which means they have the ability to spend, I think IT is well positioned, which will fire on both the engines, which is core business plus its IT business.
Now, Chakri, for a whole host of reasons, whether it is the 81 bonds that cannot be classified as equity, which was the ruling of the Bombay High Court, to results where we've seen a dramatic increase in provisioning. Look at the way the Yes Bank stock has performed. My question to you is, when this stock is down 10% and available for nearly 18 rupees a share, would you be a buyer?
Yeah, there are enough other banks which are at attractive valuations, whether within the PSU or the private space. So I'd rather stick to that because, Yes Bank still has to do a lot of cleanup of its books, which they're doing a great job, but still there's a lot more time. So I'll stay by the sidelines for now.
But Chakri, let's understand the implications of this. Let's say RBI is going to take this entire decision by High Court to the Supreme Court. Now, Supreme Court will have to decide whether Yes Bank will have to pay back to the bondholders or not. We are looking at about 8,000 crore plus. Yes Bank's profit for the quarter gone by was in double digit. Now imagine if Yes Bank has to pay back to the bondholders, and if this does not get converted into equity, what will happen?
Indeed, and that is the biggest risk, and not the one that is the risk. Second is the time risk, which is the when do these judgments, etc., come through? And when that happens, it wipes out quite a significant capital base, which will not only create strain on the bank, but also it impairs its ability to function as a bank, and because many banks is in a basic function of lending and borrowing. So, with so much of uncertainty, both in terms of timeline and as well as what it will do to its balance sheet, it's best that to stay on the sidelines of Yes Bank for now.
Manoj, how should a trader approach Yes Bank? I mean, this is one stock which is patronized by retail and HNI traders. It's a double-digit stock. It's a large name in terms of the liquidity. You can trade, easy to get in, easy to get out, and the spreads are also very narrow.
Nikunj, I guess, we need to understand the basics of any trading or investment would be when we look into there is positioning happening in the stock. Now that happens either from the cash market in terms of delivery or at least on the derivative side. So, but this is one stock, this has more rampant movement because of the news surrounding this. So I would say this is a complete avoid. So as of now, a simple way, let's say, generally what we do is we look into the 30 days weighted average of the cash position that is happened. And when a stock comes to that, that is where some bottom formation is happening. So like for example, we were talking about IT, if it is bottom out. If you go from October to November series, a lot of stocks like say Infosys at 1484 to 1488. If you go and check the cash based positioning that has happened, and we believe it might be institutions and maybe long only funds which have actually added, and we have seen a relevant long positioning in the derivative market also. So till the time that does not happen to a stock like Yes Bank, it's an avoid. We would say refrain from it and do not get into a trading bet. If you have a position, exit and try to take your money out. A lot of good stocks to get into.
Our expectations from the budget are based on three key themes. The first one being a budget that stimulates growth, as has been in the previous budgets of the last few years. The second is supporting the infrastructure growth, because infrastructure growth is key to the development of travel and hospitality business in India. And finally, a tourism booster. It is time that this sector gets a booster dose so that the sector that suffered the most demonstrated the highest level of resilience, is not only coming back on its feet, rather is contributing the maximum in terms of new job creation as well as indirect job creation.